So I think the simplest way to view it is the idea that a very large percentage of people lose money over time trading. So what I want to do is capture their losses as my gains. So therefore, I'm trying to measure what they are doing and trying to take the opposite side. It's really that simple. I'm not trying to be smarter than the whole market, right? My analysis is not going to be smarter. I'm just really trying to find where the people who have a high percentage chance of losing money, what they're doing, and make a market to them, take the opposite side. It's really all I'm trying to do. And when they all line up and I find here's a whole bunch of people that have a history of losing money over time, and they're all doing the same thing here, then I'm looking to go the other way.
And you mentioned this previously, even if you have that contrarian opinion, you're always waiting for the market to give you a sign, give you confirmation that your opinion is right. I know you've talked about, news failures and big upside reversal bars and that type of thing. Can you talk a little bit about how you wait for the market to kind of confirm your hypothesis?
Yeah, so if there's something I'm trying to buy or sell, because I think it's a contrarian trade, I'm now trying to look into why people are buying or selling that, right? What's the news behind that? Okay, let's say, I don't know, let's make something up. People are getting long oil because, oil inventories are dropping and there's a war and, whatever there is, right?
Yep.
So now I know what's pushing the market up theoretically. So I'm waiting for a piece of news to come out that confirms that whole idea.
Right.
All right. So here's a lower oil inventory number, even lower than people were expecting. So that's bullish oil, right? And then the market doesn't go up on that.
Right.
And that's, to me, market confirmation. And that's where I would try and short it.
Yeah. And a great example, was the CPI, the most recent bottom in the market. The CPI number came out and we had a huge upside reversal bar on the indexes. And that's what kind of started this most recent rally. That's another kind of good example of a news failure. Is that right?
I think that's a great example. Yeah, that was the exact low of the stock market, at least to this point, was that higher than expected CPI and the highest CPI of the entire cycle.
Right.
And the market traded down on that and then ended up closing up on the day. And that, as it turned out to be the exact low.
And a common thing I see for people who want to be kind of contrarian is they're looking at a market that's oversold. It's in a downtrend. It continues down, 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 and they're trying to take longs at all these different points. But just because a market's oversold doesn't mean it can't continue lower, right? So I think that's a difficult concept for people to grasp. But you're kind of waiting for that key moment where it reverses and shows that the character has kind of changed in the market. So I'd love to hear you kind of talk about that and how you view both oversold as well as overbought and how you take that into account into your process.
So I think that the term oversold, overbought is a price thing,
Mhm.
obviously. I think trading off of price is pretty dangerous. Um, I trade off of participation, right?
Mhm.
So it's not that, hey, the market's oversold here on a 14-day RSI or whatever. It's everybody is short here. So I'm looking to go the other way. And now the market's not going down on bad news anymore. So I do it. But so trading overbought, oversold can be very dangerous. I mean, just look at the perfect example right now is natural gas, right?
Mhm.
Um, Natural gas was hugely oversold at the beginning of this year. And it's gone down 45% since,
Yeah.
you know, and everybody, I keep saying on my on my newsletter, not a day goes by, and I'm not exaggerating, not a day goes by that either someone is telling me they're buying natural gas or someone's asking me if they should buy natural gas. And that's been for the last 6 months.
Yep.
Things down like 60% in 6 months, right? And I haven't had one person tell me that they were shorting it.
Yep.
So oversold can be very, very dangerous.
Yep.
What happens when you buy something that's oversold and it goes down? Well, now it's more oversold. Are you supposed to buy more? It can it can put you in a very, very dangerous position. It can work sometimes too, right? But when it doesn't work, it can blow you out. So I want to say it was 96, 97, somewhere in there. I had finished school and I was trading my own account, and I was trying to be Mr. Contrarian, and the market was going up, and I was shorting it. And this is when Greenspan came out and said, irrational exuberance, which you're probably too young to remember. But and I was like, oh yeah, look at me, me and Greenspan are the only ones that know what's going on. And the market just kept going up, and I kept losing money, and I was stuck in this trade. The psychology of being stuck in the short and now not wanting to miss it in case it happens. And I've been short this whole time. I'm not gonna, that whole psychology and that whole thing, I think, also taught me a lot
Yeah.
of lessons. And then a big thing for me was the late 90s internet boom, in particular the second half of 99, where everybody that you ran into was talking about how much money they were making in the stock market. It was like that was the thing to do, was be trading these internet stocks. And me sort of being theoretically Mr. Contrarian, I was trying to short it. And it was the classic, the shoe shine boys giving stock tips. And they were. But you know what? And I was shorting it. I was trying to short it the whole second half of 1999. And the market went up, the Nasdaq went up 50% in the second half of 99, right? So the idea that, yes, these people will lose money, but that doesn't mean they're going to start losing money today,
Right.
and the importance of patience and waiting for things like market confirmation
Right.
before you get short or before you make any trade is very important, which is something that came to me at that point. Which is also, by the way, when I came across the commitments of traders data right then, because the commitments of traders data, as it turned out, I didn't know then, but I know now, really wouldn't have given you a sell signal in the Nasdaq until early 2000. It would have kept you from being short all the way through that whole part of 1999. And that really struck me as something that I need. If you're trying to be contrarian, you can get run over. So that's a data point that really helps me now, at the very least, stay out of trouble.
And how are you managing risk on these type of trades? Are you putting in stops, or is it more about your position size, or a combination of both as well?
No, so it all comes off of that. So if the idea is, here's the market that failed here, that should be the low,
Right.
right? Here's somebody who was waiting 10 months in this case to short it, and he shorted it on that CPI number. To me, that person should never make money. So that should be the low. So that's what I'm trading against, is that low number, the low of that day. So I know where I enter. I know where the low of the day is, and that's going to be my stop. So therefore, I size the position between those two things to lose whatever percentage I'm willing to lose on a trade, which in my case is 70 basis points of
Hmm.
my portfolio,
Hmm.
which basically gets my portfolio to about an 8 vol, which is what I'm targeting.
Hmm.
Um, so it gives sort of all of those things in the trade.